Hey everybody, JD here with your Rational Trader Market Analysis Daily. In today's video, I want to talk about an exciting project I'm working on. I call it the Mean Reversion Cash Machine. And what exactly is the Mean Reversion Cash Machine? Well, as the name implies, we're taking advantage of stocks trading significantly above the mean. Two standard deviations above the mean is very important. And exploiting option pricing well above that price, and the fact that stocks 95% of the time are going to be trading between the bands of two standard deviations above and below the mean. What is the cash machine component? Well, specifically, what I'm looking to do is something called naked call writing. Now, on the surface, that might sound big and scary, and oh my goodness, for those familiar with options trading, perhaps you've been schooled with the idea that you have perpetual downside risk or infinite downside risk with call writing in a way that makes such a trade too risky. And while it is true there is risk with everything that you do in the markets, I'm really excited about the idea of exploiting option pricing with stocks trading closer to two standard deviations above the mean versus trading at the mean or below the mean. So here's an example. On Monday, I looked at nuclear power stock OKLO and saw that the June 20 expiration options had a premium of $1 with a strike price of 87. And on June 16th, the stock was trading, what is that? It looks like that was around $65 a share. With the mean price at 70, I selected an option purposely that was well above two standard deviations above the mean. Now, it doesn't mean that OKLO can't trade at those levels, but if you look at a longer term chart of OKLO, you can see here since the market lows in early April, this stock has just exploded higher. It is clearly a momentum stock. You know, it'd be one thing buying or writing an option on an explosive stock like this, two standard deviations above the mean at $28 a share. But at $70 a share, I feel very confident that we can basically write the option just like an ATM, take that cash, and the option's going to expire worthless. And with a day and a half left of trading, that is exactly what's going to transpire with OKLO. Now, the thing about naked call writing is that you have to have a margin account to be able to do this, and a margin account that's funded and supported by assets that when you make the trade, and let's just say on this OKLO trade, you wrote the contract at $1 per contract. Well, that would mean you collect $100, right? And the margin requirement, generally speaking, is going to be anywhere between $500 and $1,000. Okay, so that's another layer of protection if indeed OKLO traded above the strike price, which is $87. The brokerage firm has capital from you that will be even greater than that amount. So you're already starting at a level two standard deviations above the mean. You are writing an option that is oftentimes 10 to 20% above that level, and the brokerage firm takes leverage on top of that, or capital requirements on top of that, for you to collect that $100. Now, if you think about it, and I'm in the process of putting together an investor friend group to allocate $100,000 of capital for these kind of trades, especially during earnings season when implied volatility is significantly higher and premiums are just out of this world. So on a stock like OKLO, for example, that $87 option strike price with an immediate term expiration, either that day when they report earnings or a weekly option, you have the opportunity to collect an even higher premium. And so it's like ringing the cash register, in my opinion. And I couldn't be more excited about it. The capital is your capital. If it's not used, it's still your capital. So think about it like, almost like a CD, that's in the bank. Um, yes, you could have one of these trades blow up on you. The idea is, of course, to win much, much more. I'm targeting 95% success or even higher on these kind of trades. So stay tuned, folks, because this is an exciting way to trade, and I don't think you should be intimidated by the quote unquote term naked option writing. So that's all I have for today, folks. Podcast on Friday. I'll be back on Monday with another Rational Trader video. This is JD. Take care, everybody. Have a great Juneteenth, by the way. Markets are closed tomorrow, and we'll see you all next time. Take care, everybody.